Good evening, everybody. Welcome to your session, or good morning or good afternoon, depending on where you are. Good to see you here on this session today. A few familiar names. It's great to have you on board for this group coaching webinar. What the aim of today is really just to sort of, most of you have been relatively new to trading FX, is I'm just going to give you not only an overview of what FX is about, but also maybe give you a simple system just to try and start to sort of get your trading toes in the water, so to speak. I want you to feel free to ask questions at any stage or make comments. It's all good. But just so I can help you a little bit better, it'd be great just to know where you are with your trading now. So if you can just tick whichever box on that poll that's just popped up on the screen, that would be sensational. We'll just leave that up for a few seconds. And the other thing to say is, I hope you've all got access to your First Steps online course as well, which is about 24 online units to walk you through that first few, as the name suggests, first steps. So thank you for participating in that poll. I'll just close it down now. The other quick question I want to ask is just which platform are you using now? I know a couple of you are using MT5, but many of you may be using MT4. I'll explain the differences with them both. Just tick the one that's appropriate. Some people use both. Okay, that's great. Thank you, all of you answered that. That's useful to know. About half and half. Okay, so as I said, feel free to ask questions at any stage we go through. G'day, Cameron. I've got to put this up because we are looking at live markets, and as a result of that, then please just bear in mind that we are. This is for educational purposes only. So what I'm showing you, you shouldn't be trading as well, unless it fits your trading plan, which I'm guessing most of you are in the process of developing. So hey, it'd be interesting to know where you guys are from. If you wouldn't mind just typing that into the questions just as I'm speaking, it'd be great to know as well. Now, obviously, the primary aim of these group coaching sessions is to link the theory to the reality of the market. That's why we're looking at live markets. So you can move from the idea to trade to actually trading. G'day, Eric. Good to see you here. Mostly Australia. A couple from the UK. Welcome. So what we're going to do is we're just going to briefly go into, like any specialty subject, the Forex market is full of jargon. We're just going to review some of the key terms, show you in practice how people profit and minimize risk during trading, and start to look at what a trading system or trading plan is, and how that can help both manage risk and also, of course, take profit. So the world that you've decided to have a look at is the largest traded financial market on the planet. The participants in Forex are really no different to any other major financial market, in that they're banks and institutions, individuals like you or I. And what we're doing, again, like any trading instruments, we're buying and selling depending on our particular view of the market. For every trade, there's always a buyer and a seller. Now, there's a few things that are different to FX, or between FX and some other vehicles for it. And one of the first things that you'll note is that, unlike the share market where you're trading BHP or JP Morgan or Apple or Microsoft, and it's just the performance of that one company which influences price against what the market expects, with Forex you're trading in pairs. So for example, the Euro USD. That's the most common, just happens to be the most commonly trading pair. Now, you'll never see a written USD Euro. It's always in that particular order. And that first currency is termed the base currency, and the second currency is termed the quote or counter currency, depending on which textbook you read. And we're choosing to move to trade the movement of one against the other. We can class currency pairs into majors, minors, and exotics. So the majors, you'll notice here that we've listed, are all those with the USD in. The minors are a combination of the others, so the euro yen, the GB pound Australian dollar, the New Zealand dollar Swiss franc, or Swissy as it's called, or the New Zealand dollar Canadian dollar, there turn minors, and then any currencies outside of that tend to be termed exotic. So if you want to trade the Polish zloty or the Norwegian krona, then that would be an exotic. Now the implication of this is, one of the things we notice is that there's a difference in price between where the buyers are and where the sellers are. So if we want to buy, we have to pay what the sellers want. If we're selling, we have to pay what the buyers want to buy at. That difference is termed the spread. Now what we find is the majors have a very tight spread. The minors have a slightly larger spread, and the exotics usually have quite a big spread. We'll look at that in a moment. Quick tour of your trading platform. We'll look at this in some more detail here in a moment, but you can see there's the main areas are a chart area, a market watch, which has all the pairs that you might be interested in trading, your navigator, which allows you to drag different indicators into your chart area, and then you've got different ways you can put drawing tools on, etc. Different chart types up here, whether you zoom in or zoom out, and then you've got different time frames you can trade. Generally speaking, most new traders get very excited about trading with fast time frames, but bear in mind, these are probably the hardest and most intense to trade. So most experienced traders who do well at this will trade maybe 30-minute or an hourly, so that mid-range, or will go long-term and trade the 4-hourly or the daily. At the bottom, you've got what's called a terminal box or a toolbox on MT5, which essentially has your account information in it. So let's just have a quick look at that in more detail. This is a live MT4 platform. So just a few things on here. I'm just going to get rid of some of these lines just to make things a little clearer. In fact, what we'll do is we'll strip everything off. We'll leave volume on there. We'll strip everything else off. Okay, so what we can see here is, and really all price is a measure of market psychology towards the price. So sometimes I think it'll go up, sometimes the market thinks it'll go down, other times it won't be sure what to do. Okay, so, and we can have as many of these different charts and different time frames that we want. Of course, it's not just FX you can trade on MT4, MT5. You can trade indices. So we've got the US 500, which is the S&P 500. We've got the FTSE, we've got the DAX, we've got oil, and we've got, if we go down, we've got Bitcoin. If you're interested in the cryptos, not the place we'll start, but and then we've got gold and silver, which, there we go, there's gold. Okay, so that's a gold 30-minute chart or gold daily chart. So we alter the time frame with these on the top. Now you've got one of the common questions that we're often asked is, which is the best time frame to trade? Really, the easy answer to that is whatever suits you and your lifestyle. Okay, you don't want to be trading at 5-minute charts if you're not going to. If you're trading 5-minute or even 15-minute charts, you need to be watching the screen. Anything else, you can usually sort of have a quick look at the screen every now and then do the rest on the app, on the MT4 or MT5 app. I'll show you what MT5 looks like. It's really no difference at all. There we go. The only difference with this is I've actually got some trades open at the minute, as you see there, which are doing sort of okay. One's a little bit shaky, but you can see one of the differences here, and these are all share CFDs, is that's one thing. I've just closed out my index trades, but these are tradable on the ASX, and there's one NASDAQ trade that's Zoom. So that's one difference between MT4 and MT5 is that you can trade share CFDs. There are a few more indicators in this navigation box, And really outside of that, there's not a massive amount of difference between the two. So we'll use MT4 today. Both of these are live accounts, so I've got to be slightly careful in terms of what I do. Now, let's assume just a couple of things here. Let's just talk about this box here in a bit more detail. And let's look at an FX pair. So let's look at the, whoops. Let's look at the New Zealand dollar USD. You'll see there are 5 decimal places, 5 numbers after the decimal point, okay? The 4th in most pairs is important because that's termed, or that's where your pip is measured from. The 5th one is termed a fractional pip. You'll notice the pair above it is the New Zealand yen, and this only has 3 decimal places, okay? So in the case of any pair with the New Zealand yen, it's the 2nd decimal point, which is classed as the pip. And then you've got your fractional pip beside that. And it's really the number of pips times the size of the position, which equals how much profit or loss you've got. You'll also notice the spread. Now this little column here, we can knock the spread off. Okay, you can put that back on. But this tells you the distance in fractional pips between the bid and the ask. Now this is it's a plus account, so there's a brokerage attached to the trades, but the spreads are tighter with a standard account, not a brokerage, but the spreads are much wider. Now remember I said about your minors. Let's look. So there's the euro Danish krona. Okay, you can see there's 225 points or fractional pips in this spread. That's 22 pips, 22.5 pips when you're trading that exotic. If we look at the euro Polish zloty, you can see there's 169 points or 18 pips. So you've got to make that difference up before you actually move to profit. Whereas if we look to the commonly traded ones, you look at the euro USD, there's virtually 0 pips between these two. Okay, or one or sometimes 0 fractional pips between the buy and the sell. Okay, so very low cost to get in, very easy to get out of. You can see the most 2 commonly traded pairs, and so the tighter the spread are the euro USD and the the USD Japanese yen. Okay, so sorry, there appears to be a little problem with what you were supposed to be seeing. Can you see it now? Let me know. Let me know. Yeah, oh, fantastic. So sorry about that. I'm not sure why the screen paused. Let's try that again, okay? So, quickly, there's, let's get just rid of these indicators here. Many apologies for that. So quickly review what I was saying. So there's the spread. There's the 5 decimal places on most of the pairs, apart from the yen. You can see how tight most of these are on the majors and the minors, but once we move to the Danish krona versus the euro, there's 225 fractional pips or 22 pips. There is the USD South African rand, 60 pips in that, so that's a big difference. You want to add some more onto this, you simply go into symbols. Anything that's, so if we wanted to add the US dollar, Singapore dollar, just click on that, would show it, and then close, and you should be able to see that. And the bottom, you can see that is an exotic as well. Not massively bad, but you still got a pip and a half to make up. Okay, so all that should be good, right? I gather. Okay, we can make that up. So So these 4 boxes that we've shown on there, there's your time frames, there's your drawing tools, this is the chart area, your market watch box, and there's your navigator where all the indicators are, and there your terminal box at the bottom, MT5, very similar. The black is not an issue, it's just what I prefer to trade on. Let's quickly show you the major difference. There's the share CFDs that are open at the moment. It's one of the key differences between MT4 and MT5s. You can trade these as well as the FX. As I said, I've just closed down recently, just closed down a NASDAQ trade. As you can see there, I was in here and out at this point here. So a nice little trade there. I'm going to show you how I did that in a little while. Now you can see what I'm doing, of course. Okay, so let's go back to MT4. And so understanding how the Forex market works, we've covered, we'll briefly cover that. We'll have another look at charts and look at different types of charts and timeframes. We've looked at what the pip and fractional pip is, and the difference between the buyers and the sellers is termed the spread. Now, the next thing to look at is the size of a position, okay? Now, traditionally, the size of a position is one standard lot with FX. So that's 100,000 units of the base currency. So if we look at what that means, standard lot is 100,000 units. So if we were to trade Euro USD, it would be 100,000 euro. If we were to trade Aussie USD, it would be 100,000 Aussie dollars. We can also trade mini lots, which are 10,000 of the base currency, and micro lots, which are 1,000. Now, what I'm going to do is I'm going to quickly enter some trades. Now, as I said, I'd rather find something that's actually moving as I would prefer it to. And we're going to go fast time frames, and I'll give you the reason for this in a while. I'm going to just look. Actually, maybe we'll just have a quick look at okay, I'm going to look at what's up to the GB pound. Must be some economic data come out. It's looking a bit weak across the board. Okay, so we're going to take it onto a 5-minute chart, okay? So what we're going to do is going to enter 3 quick trades, okay? Whoop, no, we're going to do a sell. Okay, there's our micro lot. There's our mini lot. And there's our standard lot, okay? Now, as I said, normally I wouldn't enter these positions on the basis of this chart, but what I wanted to do is to demonstrate through practice what the difference position sizing makes. So I'm going to be quite rigid on this. So you can see that all 3 have been entered, and you can see there's not much difference in this time frame, but we've gone short all of those, meaning we want the market to go down, okay? So what we're also going to do is we're going to cap a loss on all of these trades. So we're going to cap a loss at, we entered at 178 and something, 178.90, 178.89, 178.89. So pretty close together, pip difference. So we're going to modify, we're going to place a stop, what's called a stop loss. And we're going to place this at 178.97. Actually, no, we'll do it 178, do the 179.01. Okay. And there you see our stop losses on there. Now, if we do the same for the other 2, 179, we'll just do it at, we'll just 179, I'll just do 025, just to put it at a slightly different place, just so you can see. and we're going to put this at 179.031. Okay, so there we've got 3 stops in place, all relating to these positions. And so the purpose of a stop loss is to say, right, that's it, our trading idea hasn't worked, we're out of here. So with this, with our micro lot, we're risking $1.10. With our mini lot, we're risking $12.80. And with our standard lot, we're risking $120. $133, okay? If that doesn't go away. So if it goes this way, then we'll, if it goes down, we're obviously going to profit more, but if it goes the wrong way, the bigger the position size, the more we're going to lose. So when you're starting, you should be doing this cup of coffee trade, as I would call it, in that you're risking very little, your profit's going to be very little, but at the start, it's not about making masses of cash, it's just about getting a reliable system that is going to potentially do okay for you. So I hope that makes sense, but you can see now we've got a little bit of movement. You can see how there's a fairly big difference in the positions in terms of how they're moving. It's actually not doing very much at all. It's staying pretty well near neutral. We'll come back to that. Notice the time is 5:24. I'll come back to why that's important in a while. Okay, so we've done potentially putting stops, simple lines on a, put stops on a chart. I want to just show you how to put lines on a chart, because this is important. Let's look at an hourly chart. Not a very good chart. US Canadian dollar. Okay, so now that's nice. Okay, so we've got Euro GB Pound daily chart. Let's put on hourly chart. Whoa, what's happening there? Okay, so if we put it on a daily chart, you can see that there's a clear line where markets are supported. Okay, so the price has bounced off this level a few times, and there is also a line. You can see these better on a line chart. You can also see that potentially there's a line. It's not the best example at this point here. So at this stage, what the market's saying is the price is worth more than this level, but not worth more than this level. If you want another example, this was an even better example. So this is term resistance, this is support. If you want a better example, we'll look at what happened previously. Okay, so you can see how many times this has kissed this line before ultimately we get a breakout and then we make this profit. So this concept of breakout trading is based on identifying lines on a chart. And you can see these on any time frame. You can see these starting to gap now in terms of profit and loss on that chart, even though there's not much movement. So if we look at the Euro USD on a chart right now, you can see again, always easy to put these on a line chart. You can see them better. But you can see where the support is there. You know, how many times it's kissed that, and you can see where the resistance is there. So that's how we draw lines on a chart. Now, why this is important is this potentially creates a trading opportunity. I'm going to go back a step, okay? I'm going to just talk to you about how markets move. And really there's 6 ways, okay? Uptrend, downtrend, what we call a trend pause, congestion, which is a sideways trend. Then we get congestion exit when it breaks that, which we've been talking about just now, and trend reversal. And really, it's the last 2 we're interested in terms of our potential entry opportunities. So if we looked, for example, at there we go. So again, if we look at how the market's moving here, okay, so we're going to draw this in simple terms, because it doesn't have to be complicated. So we're in uptrend here, and moving to downtrend into sideways trend. back into uptrend. We pause a little bit on these points, and then eventually we turn around and move into downtrend. So our key points on this are, so there's uptrend, let's just label them downtrend. There's congestion, it's trading a sideways trend. There's uptrend, there's trend pause. You could even say, actually this is a 4-hour chart, you could even say that was a sideways trend, but let's just call it a trend pause for right now. And then we get a trend reversal here, and we've got a trend reversal here. Okay, so our best opportunities, downtrend there, best opportunities are not in the middle of this, are they? Our best opportunities are if we pick the start of a move. So if we were down here and we picked it here and then got out possibly somewhere around here, then that would be a good trade. On this trend reversal, we want to pick it up early, and then we want to get out when it moves into congestion. On our uptrend, we'd like to get in at this point here and have it right the way up to there, irrespective of these pauses. And then we're in this downtrend, so we'd like to be in here. So the idea is that if we can just identify these 6 ways of market moves, and as I said, you can identify them on any time frame, then we are in a position to do okay. Now, there you see all of those trades have been taken out. Why? Because they hit our stop. So it doesn't get any worse than that. As I said, that's not how I would set up a trade. That was purely an exercise to show you how position size moves. So we lost $130 on our standard lot, $13 on our mini lot, and $1.30 on our micro lot. So what does that say about where you should start to trade? Okay. So knowing that, what we're therefore looking for is when, and it doesn't matter on which time frame this is, let's put it on a 30-minute chart again. So what we're looking for is when this trend changes. Okay, so we talked about congestion. So there's congestion. Okay, we can put this on a line chart and draw it a little neater. As I said, line charts, all line charts show you as the close price. But there is the bottom, which you can see there was resistance there. Once it broke through, it then became support. And there's our top. So we're trading in this range, we're in congestion. And so what we want to do is we want to pick up when this happens. Okay, and if that happens, we can get in, that's congestion exit, and we can get in on a short trade to take advantage of that. And of course, we've got to have an exit that says, okay, trend's changed again, we need to be out. Okay, so we may attempt to make profit in between this and this area, which in this case is, you see that 384 in the middle there, that says it's 38 pips. Okay, if we had a position that paid us $10 a pip, that'd be $380. Okay, so simple concept. Breakout trading is one of the simplest strategies of all. There's a couple of others which, those of you moving forward, we're going to run a special session for those who have opened live accounts. We're going to visit what's called a trading plan clinic, where we're going to run a session, and that's not in the not too distant future, so keep your eyes peeled for that. If we went on to I'm going to give you a bit more detail about this in a second, show you how easy it is, give you something to go and practice. We look at, is that GB pound Aussie? No, there's our Euro USD, exactly the same concept. Now what's happening with Euro USD? Well, it's starting to push up towards that level. If it breaks that, we've got a breakout trade potentially. Now, the only problem with this is that our next level, you can see this on the chart, is possibly there. That's our next key level, our next resistance historically. So what you tend to find is if it was a resistance before, it might become a resistance again. You can see how this was this point here, this point here, here, and here. And that's even without looking at the candles. Probably even see more touches of that. Okay, so there's about 5 candles there, about the same there, a couple of candles there, a couple of candles here. So we've got limited upside to this of only 21 pips, 214 points, so 20 pips. So that's not a very big potential reward unless you're trading a very big size. Again, we can see here, we can see a key level around this point. See how it was supported here. But again, with this breakout trade, there's very, very little before the next key level. So we don't like that very much. We want something which has got a bit more poke on it. Such as this one here. So if we look at this GB pound USD on the hourly chart, see how it was here, here, and here. From the candles, you probably see more touches. There you go. More touches of the wicks to the high and the low. So for those of you less familiar with candles, the body of the candle represents that open and the close. If it's white, it means the open was here and the close was here. If it's the other way around, if it's a dark candle, it means it's gone down during that candle. So the open was at the top and the close is at the bottom. These wicks are the high and the low. So you can see quite commonly these lines are tested with wicks. So that gives us an important clue as to what to do next. But you can see once we broke through that support line that had been tested on numerous occasions, then we got some selling coming into this position. See the strength of that candle, this volume here, you can see how volume has increased significantly. So we're putting together almost a picture of what a good trade looks like. Okay, so our aim, therefore, with our 6 ways, is to look at different clues. So our candle is a clue number 1, volume clue number 2, moving averages, key price levels, momentum, and economic data, or corporate data if you're trading shares or share CFDs. We don't want to mess with economic data because it's the point at which, when economic data is released, it's the time at which markets are most likely to move significantly. And I'll show you where to find that information out in a moment. So what we're going to do is we've not only got the movement in price, but we've got these other clues or indicators we can add to the game to strengthen our criteria that something may go in our direction. Because really what we're wanting to do is create a higher probability if we enter that it's going to continue in the direction we want. It's not about entry, isn't about profit loss. Exit is about profit loss, but we'll want it to go in our direction for a period of time. So let's look at these. Well, we've already talked about bullish and bearish candles. So if we were trading a long trade, it would make sense, surely, that it was a bullish candle. If we're trading a short trade, it would make sense that it was a bearish candle. So if we look at this GB pound US dollar chart, we'll put it back on the line chart so we can see that if we go back to the start of this chart, you can see there was a resistance at this level here at 139.11. Okay, so you can see it bounced off it, bounced off it, bounced off it, trading within a range. So this is a breakout potentially here. Okay, so we'll put the candle on. Now, what are our clues here? What do we notice about the candle for this long trade? Well, first of all, it's closed above that level. Okay, it's closed above this key line. So it's gone through the resistance line, which suggests that that may be a break, a congestion exit. And what do you notice about the price in comparison to the candle? Well, it's in the top third of the candle. So if we split this candle from top to bottom into three, it looks something like that. So it's closed in the top third. That means it's not only a bullish candle, but it's closed near the top. What do we also notice down here? We notice there's more volume associated with this candle. So that says what the market is saying is here now is that this is a bullish move and there's buying pressure behind that. Lots of people are interested in this going higher. Okay, so three things there. It's closed above the line, tick. It's in our top third of the line, tick. It is a higher volume, tick. Okay, now just explain these lines that are on here. These are called moving averages, and essentially there's a 10 and a 20 on here, which we can look at moving average crosses as another strategy. I'm not going to talk about those today, but if it crosses with the red one going over the blue one or the long one going over the short one, then it's potentially a short trade. If it crosses the other way, it's potentially a long trade. So it's another way. It's a way of determining a change in trend from up to down trend. So that's just another strategy. We're not going to worry about that for now, but we are going to put another moving average on this. And we're going to make this a 50. And we're going to make it an exponential, keep it as an exponential. And we're going to make it purple. Okay. So all a moving average does is it takes, with that 50, it takes the last 50 close prices, adds them together and divides it by 50 and then plots it on a chart. And obviously as each candle goes and it moves, it takes the last 50. So it'll be the, if you like, the next one along. So it takes the last 50, next candle, next one along, next one along, next one along. And so it's a forever moving average of the last 50 bars. The last 10 bars, if it was a 10 moving average, last 20, if it was a 20. Now, the difference between us, that would be a simple moving average. What most traders prefer to use is what's called an exponential moving average. I'll just show you why very quickly. Okay, so I'll put a 50 moving average on here, an exponential. Okay, we'll just take off these drawings for now. And then we'll put a simple moving average on, which is we're gonna make green. Now, what I want you to see, it's not great on this chart. Let's just see if it's there. That's probably better. Just take it out a bit. So remember, our purple one is our exponential, our green one is our simple. So what an exponential does is it weights the more recent ones accordingly. Okay, so when this had a trend reversal, which one moved first? Well, it was an exponential because it weighted these more recent bars more than the previous bars. And it's another significant number of candles before we get a movement in the simple. So in simple terms, the exponential moving average, because of that weighting, tends to respond to trend more quickly. In this sort of case where it shoots up big time, there's not a lot of difference really. Okay, so we go back to our breakout trade, which I can't remember which one it was now. It took all the drawings off. Never mind. Okay, another one. Might have been the same one. Let's look. You look at euro yen. There's our breakout. Okay, so at this stage, let's get it accurate, Mike. There we go. So there's our resistance. You can see it's touched, 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 and touched. And then we get a breakout. So we're getting a breakout at this point here. So what we notice the green volume bar there, higher than the previous one, higher than the previous two. It's closed in the top third. Got a tick there, got a tick here. Okay, so 3 ticks over the line in the top third, increased volume. That says the trade is looking good. And then our 50 MA, which is our green line, is pointing in an upwards direction and is our price is above that. So what does that look like in terms of a trading system? Well, we can put all that together and say, well, all of those criteria should be met before we enter this breakout trade. Okay. Now, of course, we've got to put the exit strategy in place. So what we're going to do is we're going to put a stop. I'm going to put our stop loss at this level here. So we'll make that orangey red. Let's try that again. It's that line there. Salmon, that'll do. Okay, so there's our stop there. So we're risking, there's our entry. So we're risking 27 pips. And what we're going to do is we're looking for and then we're going to put a profit target in as well. We'll put a profit target in. Very difficult to find a profit target on this. But we'll put a profit target in. We'll have to go back all the way to here to our next key level. There we go. So we're going to put a profit target in at that point there. Okay. There it was. So remember, there is, let's just put our entry line back in. Okay, so there's our candle. There's our increased volume. Tick, tick, tick. We've got to stop at this level here, and we've got a profit target here. So what happens is, because we've given ourselves a high probability trade, because we've used those extra clues, up it goes, and eventually it triggers our profit target. Okay. Now, there's another way we can do this, is we don't want to keep this stop here, because our risk here is 27 pips. Now, assume we didn't have that profit target in at this stage, could quite easily come down and be back down here. And if we don't move this, then we're not in a good place. Let's just get rid of our profit target. So what we're going to use is we're going to use this 20 EMA as what's called a trailing stop. So you can see how we placed our initial stop on this line. So what we're going to do is we're going to move it every candle. We move it, we move it, we move it, we move it. It's not closed. It's not closed below it. It's not closed below it until this candle here. So we're out at this level here, which was, in fact, around where our profit target was. So what we've done there is we've locked in profit as it's moved with us. So the closed part of the candle, just to clarify this, is if it's a bullish candle, our close price is the top of the body. Okay, so there's our close price there. In this case, there's our close price there. Our open price is here, our close price is there. Just looking through these questions, I hope that clarifies that. Yep, so the top third or the top 30%, yes, Darryl, will be a recording of this made available to anybody who attended. So well, let's look again. Let's look again at so we could have even taken a breakout trade at this point here. So forget that one for now. But we see it go into this pattern here. Let's put it on a 30-minute chart. Take it back. Let's get rid of this automatic scroll. But you can see here we had another potential breakout at this level here. Okay, you can see it bashed against this level a few times. So which would be our candle? Our candle would be this one here. There is our close in the top third. There is our higher volume. Okay, so tick, there's a close above, tick in the top third, tick on higher volume. We're in this. Let's use our 20 EMA again. So up it goes and eventually be triggered here. Now there's other ways to exit. I'll just show you one. We won't go into what this indicator is in any detail, but there's something called the MACD, which we'll put on here. Just going to give ourselves more space so you can see it. So what we're looking for here is if the MACD, actually let's make this bigger. If the MACD, this essentially is the difference between these two lines. Okay, so it's a momentum indicator. You can see the signal line. This signal line is a moving average of these bars. Okay, so what we're going to do is use a simple exit that says, well, look, if the signal line goes over the top of the bars, then we're out. So we'd actually be out on that candle there. Okay, so we'll be in on that one there and out on that one there. So that's about an 18 pip profit. Okay, let's have a look at Euro GB pound. Okay, this one that would have been current now if we'd seen it just before the webinar started. Actually, wouldn't have, it's 30 minutes ago. So there's our resistance. Okay, put it on the candle chart. Let's bring it in a bit so we can see the detail. There's our candle. Even closer. So there's our candle. You can see there's increased volume on that candle. Okay, top third. We'll be into this trade, and now we're just waiting for an exit. Now in this case, because it's gone up so fast, these moving averages are very slow because it's rocketed up. So what we might use is every time it pauses a little bit, we might just take it up to that level. So it paused there. So now our worst scenario is a win. Now worst scenario is a good win. Now our worst scenario is a very good win. Okay. So again, once you get a bit more experience, then we can go into the different types of trail stop methods. We actually have a number of different educational offerings. We're running in a circle program every Wednesday. We have a daily update or daily live look at the markets on a Tuesday and a Thursday lunchtime. And then we've got separate sessions. We've got as I said, we've got a clinic session on trading plans, on exits. The first steps course is great. It'll tell you all about trail stops, etc. So make sure you make use of that. Now, sometimes is the case. So we're not seeing anything that's moving right at this second. See how this is why it's called support, because it's bounced off that support. Hold on a second, I'm just going to shut a couple of things down. Okay, hopefully that'll make things better. I was just getting a message there that we're starting to lose. I might even close MT5 down. Starting to lose a little bit of quality of transmission. Let's look at something else. Let's look at Euro Kiwi. Same deal, put it on a line chart. You can see there's your breakout line. See how it was. Let's put it more accurate. Always best to do it on the line chart first. There's the breakout line. There's the breakout trade in the top third. There's your candle, high volume compared to the last candles. So we'll be in that and we'd look for a profit target around about this 166.62. So around about 50 pips profit on that. So let's just put some of that together. So there's just a little bit of a reminder about what resistance is. So we're looking for a breakout. We're looking for three attempts or more, but we need to be patient. We need to make sure that it's actually broken out. And that says sentiment has changed. We're now in an uptrend rather than sideways trend. Support is the reverse. So support, we're looking for a breakout to take a short trade, as seen on this. And that's an indication of moving from sideways trend down into downwards trend. I'm not going to talk. I just want to briefly go over some things. Why we're so rigid about having that risk stop in place is you'll see these two traders here. We've got one trader who's got 4 wins and 2 losses, another one who's got 2 wins and 4 losses, and you would assume that that better win-loss ratio for trader 1 would result in better results, but no, wrong way. Where is the, oh, good grief, where's it gone? Okay, because it's not about those, so it's about keeping your losses small and letting your profits run. So let's have a quick look at what that means. So with trader 2, who we thought did very badly, let's assume this loss was 80. Let's change the color of the pen because that's not very good. Let's assume the loss was 80, 60, 50, and 80. So we've kept our losses small all of the time. And our wins, because we've let them run, because we've had that trail stop system, let's just say that that is 210 and 250. Okay, so if you add that up, that's 260 profit. Sorry, 460 profit. We've got 160, 250, 250 went against us, so we've made $210 profit. Whereas this trader 1 had a good exit, good entries, it looks like, but didn't set that stop loss, didn't have a system to trail a stop, and so what happened is the opposite of what should happen. So he kept his losses small. Every time he went to the profit, he said, oh, I'll take that. So we'll take that $100 win, we'll take that $50 win, we'll take that $30 win, and we'll take that $90 win and say thank you very much, because you never go broke taking a profit, which of course is nonsense. Because what he did with his losses is he let them run, he didn't have a stop, so this turned out to be 200, and this turned out to be 200. So in fact, even though he had a 4-to-2 win-loss ratio, or 2-to-1 if you like, his wins equated to, what's that, 150, 180, 270, and our losses of 400. And so ended up being minus 130 down, whereas if you remember, this guy was 210 positive. That is why we have a stop loss in place. Okay, just have a quick look. When you talk the bottom third, are we looking at the solid candle or we include the wick? Good question, Cameron. Yeah, we include the wicks in that bottom top third. So the range of the candle is the top of the highest wick to the bottom of the lowest wick. Okay, so the high versus the low of that price period in the candle. Okay, so what we're wanting is it to close in the top third of the whole candle movement. So that body has got to be, that white body has got to be essentially closing in the top third. Great question. So I hope that sort of answered that. And obviously, if it's a short candle, we're wanting to, if it's a short candle, we're wanting it to close in the bottom third. If we're looking to go short, if it's a breakthrough support. So this is why it's really, really important. It's all about exits. People talk on and on and on and on and on and on and on about entries, but really it's what happens next, which is the major determinant. So remember that market cliche, keep your losses small, let your profits run. You let your profits run by trailing that stop, locking in profit. As a trade moves with you, you're always going to have to give something back. You're never going to hit the top of the market or the bottom of the market if you're going short, so you're always going to have to give something back, and that's what this is about. It's a numbers game. So that's why you set a stop based on a level that you think this means my trading idea has gone against me. So we look at this again. If we entered on this candle here where would be a reasonable place to say, look, this hasn't broken out, it's trading back into the range. Sorry, it's trading back into this range. We don't really want to wait until it's gone all the way down here. By the time it gets back here in the middle of this range, we know it's not a trade that's gone with us. Okay, so we just cut it off, we get mercenary about it, chop it off, and then we're in a good place. We've retained our capital and most of it, and we're ready to take the next trade. Now, just to give you a quick run down, I'll quickly just show you. I don't usually do this, but I will, just to emphasize the point. We'll talk about profit targets. Just clarify that in a second. Oh, I've closed it down. Okay, never mind. We'll come back to it. So we've covered stops, but profit targets, just to clarify, what we're usually looking for a profit target is we set it on the system and we say, well, look, this is a short trade. There's the next support. So we're just going to place it below that, because more often than not, what's going to happen is it's going to come down, test that support, and then bounce off it. If it doesn't do that, if it continues to go through the next support, we've taken our profit off this trade and we're ready to go again. Okay. And as I said, we can put these on our platform. So in the same way, I'll just show you that. Let's find something that might or might not move. Actually, let's just put a MACD on this. No, not yet. Okay, so let's say we were to enter here on a break of this level. Okay, if it pops up here and goes over this level, then we may say, well, look, where's the next key price point? Well, it's there. So that we're going to set our profit target just underneath that at this point here. Okay. And we're going to set our stop at this point here. So if we are entering here, what this is saying is, this means our trading idea has gone against us. This means this is the maximum potential for this particular trade phase or price phase. But of course, if it does get up here and then it continues and we get a nice big fat candle here, which is towards the top of the candle, then of course what we can do is we can re-enter this trade based on a new breakout of that key level. Okay. So let's put this together. Let's look at a simple entry decision tree based on what I've told you. Okay. So first of all, so this is a long trade. If you want to take a screenshot of this while I'm talking, that's fine, but we'll just go through it again. So is there a close price above the resistance level? Then we can say tick. Is the price in the top third? Tick. Is there increased volume? Now we can say increased volume from the last buy if you want, then we can place a tick. Now the last thing is there no imminent currency related data? If there's not, then we can enter the trade. Okay, that is a simple system that people use irrespective of experience, but the difference is from what I've taught you today to what most people do is, first of all, I've given you a plan. Now, somewhat startlingly, I went to do a seminar, and this is to experienced traders, about 3 weeks ago. And I went through what I thought should be in a trading plan in terms of or what a trading plan should consist of. It should have a clear entry criteria, which are unambiguous, and then clear exit criteria, which are exactly the same, they're unambiguous, you know exactly when to take action. And I gave them a few pointers and I said, how many people have a trading plan that looks like this? Really simple one that I've just shown you. And in that group of 40, less than half put their hands up. Less than half. Now, the other key system that you'll need to learn about as you develop through your trading career is you need to measure the success or otherwise of what you're doing through journaling your trading. So let me give an example of the power of that. So first of all, it's almost a self-accountability. You're journaling your trading, you're seeing what happens. Now, let's say you got two strategies. If you journal your trading, you can start to compare one strategy versus another. If you journal your trading, you can start to see, well, look, if I want to say, well, look, my stop is going to be, there's something called an average true range, which is about the candle length. I'll just show you that quickly, just to give you an example. I like this, I like the average true range, but what it is if we looked at this, we might say, well, we want to just increase the likelihood that this is a oscillator. So there we go, average true range. We want to increase the chances that this trade has been an actual breakout. So this ATR, what it does is it takes the last, it's default is 14, but I tend to set it to 6. So it looks at the last 6 candles and says, what's the average length of that bar from top to bottom? Because that's the average length of a bar that we can say now. So that measures what's called volatility, okay? So you can see here that it's a 0.0016, so that's 16 pips. So if we said, well, look, we want to make sure it's a breakout. So what we're going to do is going to use half an ATR above its current price. So that would be 179.15 now, so it'll be 179.23. So our actual entry would be at this point here. Okay. So it's just a to be sure, or reduce the chance of it sort of just popping up and then popping back down again, as it sometimes does. It takes out, you'll notice on some of the charts we've shown today. So if we look at this, so this is what it prevents, okay? It's a perfect example. So there's our resistance, okay? So we look on our candle and we can see it actually closed above this. So if we put this average true range on, we can see at this point here, the average true range was about 10 pips. So if we put it 5 pips above this line here, it would be 124.97, okay? Okay, so 124.97 we said. And so that candle there, and these wicks haven't actually closed above that line, and that was a false breakout. Okay, so let's say we incorporated that in our plan as well. But if we just start with that simple plan I gave you at the beginning, and then you heard me talk about this thing called an ATR, which might reduce false breakouts, then you could look back at your trades and say, well, look at the trades that I entered. Was that candle bar, did it close half an ATR above? It just didn't close above the resistance line. It closed above the resistance line. If you've got a record of the trades you actually took, then you can apply that. You can look at the trades you took versus the trades that you wouldn't have took with that half an ATR and see if there's a difference in dollar result. And then you can make a considered decision about whether this is something you want to include in your trading plan as an individual or not, because you saw no difference. Does that make sense? So your two key systems are your trading plan and your trading journal. So if we were to include that, then our trading plan would look something like this. There is no white. How bizarre. There it is. So we could then say .5 ATR. It's really hard to draw with a mouse pad. Above a resistance level. So on evidence, we've changed our plan accordingly. But we could only do that if we're measuring what we're doing. And then we test whether adding something else would make a difference or not. Now, let's say that's our entry plan. So our exit plan is really simple. So we're checking the chart now. How often should you check the chart? Well, look, if you're trading a daily time frame, once a day is enough. If you trade, or maybe twice a day. If you're trading an hourly chart, you should really check it at the end of every candle. So I would say at the end of every candle, it's a good idea to check the chart. Now you can do this on the app. You don't have to do that on. You don't have to go back to your computer screen and have to pop in with that every hour. You can do it on the app, on the MT4, MT5 app. The guys in support will tell you how to add that to your account. And so you can just do that. It takes you about a minute to alter a trail stop. So there's two key questions. Is your stop loss triggered? If it is, you've exited the trade. If your profit target's triggered, you've exited the trade. If it's not, you're still in it. But what we're going to do is we're going to trail our stop. So as it moves, we're going to move up that initial stop using the 20 exponential moving average. Then we're going to leave it and we're going to check the chart. And this is your new stop loss. So has the stop loss been triggered, profit target triggered, and round the circle again until one of these happens. Does that make sense? So let's just go back over that again, okay? Just to take you through it and show you on an actual trade what that could have looked like. So this is an interesting one here. Okay. So here we have a resistance line. There, you see resistance there, and there. What do we need on? Well, we need an ATR on there. Talked about that already. We'll make this a 14 because it's a default. Oh, sorry. Okay, so we're just going to change this to 14 because that's the default setting. Why I've changed it to 6 is another story for another day. So we'll look at this point here and we see the ATR is around about 13 pips, so 0.0013. So half of that is 6.5 pips. So using that line there, 139, let's call it 7. So 139.40 is going to be our actual entry level, okay? Oh, come on, Mike. Okay, so we say 139.40. I'll make this green so you can see it. We'll take the scroll off and we're going to zoom in. Okay, so again, you can see that. So that's our level there, okay? Now, volume. I'm going to put some volume on it. There we go. There's some volume on it. So looking at our plan, and you've got the 20 EMA on there already in the blue line. So on a closed price, or if we put it on the system, it's going to be an anytime touch of that. But what do we notice? Well, is that in the top third? No, it's not. Is that in the top third? No, it's not. Is that in the top third? Well, now we're getting to a point where we've given away quite a few pips. Oh. Okay. That's fine. Let's go with it. Whoa. I can't remember. Where was it? There it was. Here it is. Okay, so we're in this on this candle here. Is that high volume? Well, we look down and no, it's not. So we're going to have to leave this trade. It doesn't fit our plan, so we'll go look for something else. Okay, so we'll go look at, let's look at GB pound. Let's look at, Let's look at our Euro New Zealand dollar on the 30-minute chart. Just give it a chance to catch up. There we go. So we look at this and we sort of say, well, look, where's our ATR? It's 21 pips above, so half of that is 10 pips, so we want it at 166.13. We don't like that chart either, so we're going to go somewhere else. We don't like these long bars to enter on. Let's look at US yen. Not likely to find much here. There we go. Okay. Don't like this very much either. Okay, that's not going to give us an entry. It's a bit of a yes to the ATR exactly shows volatility. So the bigger candles, the wider the volatility. Let's look at another. Let's look at Aussie Kiwi. Okay. Right. Let's just choose a short one. It's really important you adhere to your plan. You don't get itchy trigger fingers, okay? So that's why I'm getting picky about finding an opportunity that fits our plan. If it doesn't, we leave it because there's another opportunity coming along sometime soon. Okay, so we need our ATR on there and we need our volume on there. Boom. Okay, so we go back to our plan. So there's our breakout. So we're looking for a short trade below this support level here. So the ATR at this level up here is around about 7 pips. Sorry, it's not. It's around about 10 pips. There we go, 9 pips. Okay, so we'll say 9 pips, or let's say 5 pips below, let's call it 5, below 107.95. So want to close, it's near 179.96, say. So want to close below 107.91. Okay, so there's our actual entry line. So does it fit our system? Is it over half an ATR below that line? Yes, it is. So we can go tick. Okay. Is it in the bottom third? Yes, it is. We can go tick. Is there increase in volume? Well, absolutely, yes. Increase in volume into this, that's even stronger. So that's the bar we're interested in. So does it fit our entry? Yes, we're in. Okay, so now we're going to put an ATR, sorry, now we're going to put a moving average on this. We're going to put a 20 moving average. As I said, we're going to use the exponential because it fits trend a little better. So we're going to make this orangey red. So we're going to set our initial stop. We've entered here. We're going to set our initial stop on that 20 EMA. So there's our stop. What we'll do is we'll just try and click on this line. And we'll make this red to make it easy to see. Or maybe one of these salmon pinky things as well. Okay, so there's our initial stop. So our risk on this, remember risk level is important, is 16 pips. So what we do is every time there is a new candle, we take it down to the next 20 EMA. This candle, take it down to this 20 EMA. Now, as I said, this is getting too far for my liking. I'd probably move it down to the 10. But let's stick with the simple plan to start with. So as it moves down to here, you can see we're just starting to lose a bit of momentum. Then we get this big bar down. So we're down to here on this bar. We're down to here on this bar. We're down to here on this bar, and then it gets triggered on this one. So we've locked in whatever that was, 21 pips, and remember our risk was 14 pips. Okay, so simple system. And we're setting up to the upside. Setting up to the upside. There's a resistance level kicking around there. So again, follow the system. We are 7 pips above. So let's say 4 pips above that. So we'd enter at 107.77. So that would be our actual entry. Because of this previous line here, remember that was up there, we're going to place our profit target a little below. Let's actually put it half an ATR below. So we're going to put our profit target here. So if it breaks this level here, we were in at this point here. If it closes above it, we'd have our stop somewhere down here, and we'd have a profit target. TP is take profit up there. So we already know all of that before we enter the trade. And then we just follow our plan and follow that exit down to there. Now, if we'd use the MACD, remember I showed you the MACD before, would that have made any difference in terms of our exit? Well, it's all about the signal line. So in this case, because it's a short trade, we'd be looking at a signal line. There it is, the signal line below the histogram. So we'd be out on that one there. Would actually be a better result. It would be 30 pips rather than our 24 pips or whatever it was. But again, if you've followed your plan religiously, if you've journaled your trades accordingly, then you can see, well, look, then you can do a comparison. Well, look, if I'd used the MACD signal line instead of my 20 moving average, which would have given me the better result? But you can only do that if you have a plan, you trade the plan religiously, and then review that plan, okay, through having a trading journal. So there you go. So there's the simplest system on the planet. Now, just to complete the story about my seminar a few, as I said, 3 weeks or so ago with experienced traders. So less than half had a written trading plan that covered all of the things they had to cover with my criteria checklist. And even worse, less of that 40, there was less than 10, I think it was 8 or 9, put 100% they had a trading journal. So less than 25% of experienced traders, these are guys who've been trading for decades in many cases, but certainly for years, didn't have the 2 critical systems in place. And then you hear figures about, well, look, 70% of traders don't make a lot of money. 50% lose money. And you wonder why. The message is clear. If you have a trading plan, you trade that plan and you review that plan and amend it accordingly based on evidence of the trade you're actually taking, then you're putting yourself already in the top 20% of traders. It's really that simple. It's not rocket science, and yet what people do is they have entry indicator after entry indicator. So they'll have what I've got on here, and then they'll add an RSI onto it as well, and they might add an awesome oscillator on there as well. So this is an actual, I do one-on-one coaching outside of Go Markets with some traders, and this is what I'm actually showing you, a real deal, what their chart looked like. And then not only will they have on those 2 EMAs that I was talking about, so they'll have the short term and the long term. So we'll just stick another short term on. Let's make it a 10. Whoops. Let's make it blue. And then on top of that, let's put a 200 on just for the hell of it. 200 is an important one, but usually on daily charts, I'm going to make that green. Doesn't make any difference of 30-minute charts. And so that's what the chart will look like. It looks very pretty, but imagine from what I've told you and an ABC system, which is really easy to trade, imagine trying to trade a system which takes into account all of those things. And that was a trade, that was a chart I actually saw from a client that first started working with about 6 weeks ago. Chart looks nothing like that now. And he's trading exactly the system that I've told you about today with a couple of little tweaks in there. But I don't want to overload you with more information than possibly you can deal with. So what we've done today is we've sort of tried to cover some basics of the FX market, some how your trading platform works. There is, I'll give you a link now actually. Just give me a second to help you along your way. If you want a link, let's just go trade. If you want to know, right, I'm going to just paste this link into the chat box. Okay, there it is. It's in chat if you want to click it, but there's some stuff on how to use MT4, and MT5 is pretty similar on opening new orders, adding lines and indicators, using pending orders, exiting trades, all that sort of stuff. There's some user guides there to get you going. Now, depending on where you are, you might want to attend some of the other things that are going on. So I'll just put a couple of things up here that are coming along in the near future. Right, Inner Circle may be a little bit much for you, but if you've done any trading at all, it's going to be useful. It's about getting into the optimum trading state. A lot of trading is psychology, and Inner Circle runs every Wednesday evening, Australian time. So I'm going to put that in there. Well, there we go. Sorry, I forgot to click send on that user guides link. If you want to join the Inner Circle, guys, they're just, it's okay if you don't get everything. There's recordings done of all of these sessions, and it'll just be there for when you're ready. But it's a once registration, but that's possibly a good thing to come along to at some stage. That's in chat as well. So really at the end of the day, some of you will have just started, others of you have sort of been trading for a little while now, or on the demo platform for a little while. There is a point at which you do need to go live. Now, if you do, what I would suggest is put just a couple of $100 in and trade those cup of coffee trades that I talked about, those micro lots. Because what it's about is, in the first instance, it's not about making lots of cash. But if you can trade something that gives you a fairly reliable result, so if you can make on average $5 a trade or $3 a trade on a micro lot, then it's $30 a trade on a mini lot, it's $300 a trade on a standard lot. So start small, get your confidence up, get your results going, get all your systems in place, work through that course, do those cup of coffee trades, and then, and only then, do you scale up. Okay, so that is the process I would suggest. If any of you want someone to give you a call about opening a live account, just type in yes, Mike, in the questions, and I'll talk to the guys and get them to give you a call. And as part of that, then look, what I've said to the team is look, I'm happy to give a half an hour one-on-one with anybody who's going to take that step, just to make sure you're set up right, etc. Okay. If it's not right for you right now, then keep on doing what I've talked about today. Practice that simple system that I went through. As I said, it's something that is relatively easy to get started with, and possibly something that's gonna you're going to be able to use or at least amend going forward just to get you kick started. The demo platform teaches you how to use the platform. You need to play some trades to teach you how to trade. Those of you who have answered yes, I'll make sure that somebody gets in touch and helps you along your way. If not, then it's been very, very cool to have you with us. Thanks for all the questions and participation. Sorry about the little technical blip at the start. I'm not sure why the screen froze, but we got through it. And I hope since that moment, it's been a benefit. It's been useful in terms of taking you from where you were at the start of the session to perhaps a little bit further along on your trading journey. Remember, there's no rush in all of this. It's about putting the right things in place, then making them happen. My email address, if anybody wants to drop me an email, give me a bit of feedback or tell me what they need next, is mike.smith@gomarkets.com. Be happy to hear from you at any stage. Point in the direction of any resources. If you haven't got access to the First Steps course, get it. Drop me an email. I'll make sure that's switched on for you if it's not been already. And of course, if you're in the market already, trade safe. In either case, just watch out for tomorrow evening if you're in anything, if you're holding anything through tomorrow or tomorrow night, Australian time, tomorrow evening, UK time. The Fed chairman, Powell, is doing his policy statement after the interest rate decision in the US. That is potentially a market mover, a significant market mover. So just be careful if you're holding any positions overnight on tomorrow. Okay, well, for now, it's been a pleasure and a privilege. Thank you once again for all your participation. If you wouldn't mind, the guys like me to run a little evaluation poll just to see how we went today. It's a slightly new format today than we've usually used in the past to people who have just started. So just give me a little bit of feedback. That would be awesome. Tick the box which most closely reflects how you felt about the session. And either way, it's good. Some of you will have found that a little more difficult, but I hope you've at least grabbed some concepts. And once you work through the course units and perhaps watch the recording, I think you'll find it a lot easier. Thank you very much for that feedback. Really appreciate it, and you're very welcome. Okay, guys. I will drop me an email about the video recording, and I'll get you that, Mike. If you just drop me an email through. All good. Okay, guys, take care of yourselves. We'll hopefully see you again soon. As I said, you're very welcome to pop along to Inner Circle, so we'll catch you again in the not too distant future. Take care. Enjoy the rest of your week. Bye-bye for now.